Hi, this is Steve, and welcome to the next edition of Highlights, your free educational resource for the candlecharts.com family. Now, as you know, or maybe you don't know, depending if you've looked at my other more advanced educational resources, one of the techniques we've been focusing on, and these are not in my books, all my newest educational resources really are not in my books. And we have something called the Trading Triad Success System, and I actually register that with the government. And triad is Latin word for three, and the approach we take in our more in-depth educational material, it's a three-legged approach. That's where we get triad from. And the first leg, and this is my specialty, obviously, because of my revealing it to the Western world back in the mid-19 or latter 1980s, candlestick charting techniques. And the second leg is Western tools. Now my niche is candlestick charts, but I've also used Western technicals for over 30 years, and I certainly incorporate and strongly suggest you also adding Western technical techniques to your trading arsenal, because if you have a candlestick signal confirming a Western signal, or you could view it the other way around, a Western signal confirming a candlestick signal, you've greatly increased the likelihood of a reversal. The Japanese say, like cords in a rope, each is individually strong, but when interwoven and used in a rope, the cords become even stronger and more powerful. So it is with East and West. But the third leg, equally important, is money management. And obviously, in this brief highlight issue, we won't have time to go into all the depth, the hours of material I have on money management. But this includes risk-reward analysis, adapting to the market, what I call candles in context, in other words, looking at candle signals in relation to the overall market, and so forth. But one of the major aspects of successful traders, based on my dozens and dozens of years working with institutional traders, is the overwhelming importance of using protective stops. And one of the great things with the candlesticks is you could use candles to set stops. So let's go through this, and I'm going to talk about a hammer, but the concept I talk about using candles as an area to define your protective stop out area, in other words, your risk, is true with all the candlestick signals. Now, the hammer, very basic candle signal, and I'm sure most of you are aware of what the hammer is. Very long lower shadow, at least twice the height of the real body. The market's in a downtrend, and a small real body that could be black or white. And one of the things you could do with the hammer is set the low of the hammer as a support area shown by this yellow horizontal line. So if the market closes under that low, if you're long, you're wrong. And so let's look at an example. And actually, I've chosen an interest rate market. The candles can be used in all markets and all time frames. My focus over the last, I don't know, 12 years or 15 years has been on equities in the 1990s because of the very volatile nature of the equity markets back then, and still today, and more recently in the forex markets, and from time to time commodities as well. But you can use candles and interest rates. So here, this happens to be bonds. It doesn't matter. It's a daily chart. It could be a 30-minute chart. It could be a forex market. It doesn't matter what market, what time frame. So here we have a hammer, and it's okay to have a little bit of an upper shadow like this. And this hammer looks okay because it's confirming the lows that we had a few sessions before that, these lows here. So if we're thinking of buying on the hammer, and then the next session, look what happened. The market closed under the low of the hammer. So if you were long, you should be out of the long position. My suggestion is setting stops, protective stops, before you put the trade on, because when is it that you're most objective? That's right, before you have a position on. It's very hard. And, you could do this if you're really professional enough and have enough mental equanimity to do this. You could use mental protective stops. In other words, set a stop after the trade is on and just watch the market. But that's very hard to do. The time you're most emotionally objective is before you have the trade on. So, before this trade was placed with the hammer, you should say to yourself, if the market gets under the low of the hammer, if you're long, you're wrong. And this is what unfolded after here. So you close into the stop, and this is what happened after. And although the market did have a little bounce back, the reason for you being in the trade, in other words, the hammer, was negated, was voided with the close under the hammer. And look at how much you would have saved by using the protective action of stops. The traders who are around the longest are those who take the small hits, the small stops. Those who get blown out are the ones who take the 2 or 3 huge hits that could take months and months to recoup. The most successful traders that I work with take small stops. They're just, they know they're wrong right away. If the market closed under it, if they're long, they're wrong, and they get out and don't have second thoughts about it. So, hope you enjoy this issue of Highlights, and may the candles continue lighting your path to greater profits.